life cycle of most financial ideas is shorter than that of a mayfly. They're born, put into print and die unlamented. But occasionally one catches the zeitgeist and survives. Those who bought in early make a lot of money. Those who arrive late to the party typically don't. And the popular idea of 2009 was Mohamed El-Erian's new normal, which morphed into lower for longer interest rates, still 6 years on at zero, and has now been superseded by secular stagnation, the latest name for slow economic growth with little in the way of inflationary pressure. Now, just how deeply this notion's now embedded in economic thoughts shown by this red line here, which is the long-run forecast of US economic growth. That is, the forecast for the 5 years starting in 5 years' time. It's back down now to the low that was predicted in 1996, just 2.2% a year, a miserable level suggesting that economists are properly glum. Now, it's easy to come up with gloomy predictions. Demographics are working against the economy as baby boomers retire and immigration becomes a dirty word. High debt levels make it hard to imagine regulators delighting in another borrowing binge as in the past. And the rest of the world's in a pretty dire state too, making it really hard to believe that the US is likely to be boosted by exports. On the other hand, growth turned out much better last time. This blue line shows what happened in terms of GDP growth. I've offset it, so this is at each point what actually happened compared to the forecast. Now, you can see later on in the 2000s, from 2000, the dot-com boom, right up until the financial crisis in sort of 2007-8, the forecast was up at 3%, which was pretty strong. Economists were confident that the US economy was on a solid footing and for the long run would be able to grow at this sort of level. Now, they turned out, of course, to be wildly overconfident, as you can see. The economy barely grew at all after the financial crisis. This, remember, is offset by 10 years, so this is the period including the 2007 to 2009 crisis. And even the latest figure is still well below what was forecast. Now, since the crisis, the long-run prediction, I should say this is collected from the same regular survey by Consensus Economics, that long-run prediction's been coming down steadily as the secular stagnation thesis spreads. The question now is whether it's gone too far or whether this is just the beginning of something much worse, as happened in Japan, where this just carried on declining as deflation set in. The latest economic data in the US hasn't been great, with weaker than expected consumer confidence and capital goods orders as well coming in rather lower than expected today. Investors hoping that rising wages and falling unemployment are going to boost corporate sales have also been disappointed, as you can see by the bars here, which show the annual change in sales for the S&P 500. Of those S&P 500 companies that have reported so far, third quarter sales per share are just slightly down year on year. That's the first time that's happened since the aftermath of the last recession. The recessions are these pink bars here, and you can see there was a pretty bad drop in sales when that happened, not surprisingly. Now, this drops in spite of the fact that companies have been on a buyback spree trying to cut their share count, which means sales per share, even if sales in absolute terms stayed flat, sales per share ought to go up as the share count comes down, but they still haven't managed to do that. The combination of so-so growth in the US and a strong dollar looks like it's really hurting. Of course, those who bet on stagnation have done very nicely in recent years, as bond yields have come down. Boring, safe dividend companies have done very well, along with new technology companies able to expand whatever the economy does. That's things like biotech or social media. Or indeed, of course, Uber and private sector stuff coming out of California recently. Now, the danger for investors isn't that the thesis is wrong as such, but that it's too popular, meaning that the best days for these trades may already be behind us.